I'm joined today by John Landis, Managing Director of the Investor Team at BMO Sponsor Finance, and Dan Weeks, also a Managing Director at BMO, focused on origination. John is among the incredible investors sharing insights at the Fixed Income and Alternative Credit Investment Forum today. Welcome, John and Dan. It's great to have you with us.
Yeah, thanks
Thanks very much.
Why is direct origination capability so important in private debt?
Yeah, it's a really good question. It's really the lifeblood of our industry. You want to pick the very best deals, and so you want to make sure you have really good deal flow. We see 1,500 plus deals a year because of the relationships that we have with the sponsors. That's really important for a number of different reasons. Number one, it allows us to pick the best assets, the very best assets. Our strategy is to over-originate and to make sure there's no adverse selection by having a low N and a low number of deals. It also allows us to build really, really good relationships with the sponsors. That helps drive outcomes via admin agencies, which is where you lead the deal. So we get to drive the structure, which helps influence when we're back at the table if there's any softness in the deal. And it also makes sure we get a last look at some of these deals as well. It's a very competitive market. We've known most of these firms for 20 plus years. They've worked with us. And if we're off on a term, we'll get a last look, which is important for the business.
And I think the investors value that direct connectivity that we have with the sponsors and the uncorrelated and unique origination that we find as a result.
Yeah, and I would just add, as part of that origination, we have 4 industry verticals that we specialize in. They value that insight that we provide by industry sector. And part of that is because of the direct relationships we have with these folks.
And the volume that we're doing in each one of those industries, which can be much larger than any individual PE firm. So we can add value back to them, which helps us in turn to earn the lead role in those transactions, which is important to us and our investment partners.
Good point.
And why do you value deal sourcing from private equity sponsors in undertaking your direct lending activities?
At the very basic level, it's probably just there's a lot of deal flow. So a lot of activity, a lot of transactions. That's important for new deal flows, but also for existing portfolios. If you look at the deal flow, it's obviously new LBOs and M&A volume, but also activity from add-ons in the portfolio. We have 300 plus in our portfolio. So for private equity firms, we see the upfront LBO, we see add-on activity within the existing portfolio. So it helps our investors that we work with deploy more money faster. And then because of our direct originations, which I talked about a minute ago, it gives us opportunity to look at proprietary deal flow from these sponsors. The other thing is sponsors are sophisticated, right? They have a pool of capital. They often have operating advisors. They've all been investing for a very long time. They oftentimes have industry expertise that lines up with ours. Those are all valuable, both when underwriting a deal initially, but also on the backside. If there's any softness, they have capital and the expertise to support the businesses. And those are probably the couple of reasons why working with sponsors makes a lot of sense in the direct lending world.
But we've also seen over time, I think, that the rational approach from the financial focus of the sponsors really helps, especially in a workout situation where, if we're engaged with our workout team, but also we can bring the stakeholders to the table as the lead agent in a deal, and leverage that relationship appropriately to support the business and affect a better outcome for our own internal book of investment and our investment partners' book at the same time.
And John, how do you view the relative value between North American, European and Asian, including Australian, private debt in the current environment?
I think it's really a factor of the depth and breadth of the market and therefore the quality that we look to achieve that Dan mentioned earlier from the origination perspective. I was involved in it with a group on a panel in London, and we were talking about CLOs, which we've done for the last 12, 13 years now. And they said, it's really hard for us to get enough origination, right, to get a diverse portfolio to put together. So if they were doing 20 or 30 deals a year, that would be a lot, both UK and I think even on the continent because it's so segmented, for example. And I think similarly in Asia, there are unique risk-reward opportunities, and there perhaps can be a little bit more return, but with a little bit more risk involved, and at the same time, the different legal patchwork. So for the U.S., I think we have a little bit more benefit from the larger, deeper market and the continuity, if you will, on the origination side, and therefore the result that we can offer to investors.
And what do you find to be the biggest disconnect between investor perceptions and the reality of the US middle market?
Oh, I think we can both talk a little bit about this, but it's one of those where I think the news media has focused really on the larger asset managers, many of whom we used to compete with, who have since raised a lot of capital and gone up market because they can't deploy the capital in the core middle market. And if you think about a sliding scale where the lower end has the highest quality and the larger end is just the larger end, right? It really, the quality falls off pretty quickly. We may have found opportunistically, we may have ended up in the sweet spot, if you will, because we get enough deal volume and flow, but maintain the good quality with the underwriting terms that we bring in at the outset as a lead in the deals. And I think that it creates a very positive result, again, for us and our investment partners.
Yeah, and the core middle market offers more protection for investors and for us as an underwriter and a manager. All of our deals will have a covenant. The larger market doesn't have a covenant. That allows you to be back at the table sooner with the sponsor to hopefully improve outcomes versus sitting on the sideline in a larger deal. It also gives you more access to management and the sponsor in diligence up front. We're partnering with folks, early on. Our diligence process can be 3 or 4 months where we get a book early on. We're going through a data room with thousands of documents, underwriting the deal and closing it. And so it's access to management, the sponsor, and information that allows us to underwrite deals better.
And when it comes to direct lending, how are investor expectations evolving around alignment and co-investment?
So we look at those as two different things. A lot of people call co-investment alignment. We think the alignment comes from the fact that as a balance sheet lender, we're investing our own institution's balance sheet capital in every deal that we originate. And so then we share in that exposure with our investment partners because we invest in the same deals. So on the alignment side, I think we're covered quite well as a result. The co-invest side has become very fashionable with investors of late, maybe even the last 5-6 years. But the problem is that you have trouble avoiding things like adverse selection because there's really not a syndication market anymore. When a sponsor comes to Dan and our other team leaders around originating a deal, they're saying, okay, BMO, we'd like you to lead the deal. How much do you want? And we have to speak for a number. We can't just say, oh, we'll take 3 times that amount and hope to place it with friends and family. So what happens is the syndication part of it comes in the large market deals where they can take these bigger holds. So you're adversely selecting yourself in a sense because you're going into larger market transactions with lower underwriting quality where there might be a little bit more syndication opportunity. So I think it's a sliding scale, but also a risk.
And why do you think fixed income investors are increasingly looking to private credit opportunities?
From a fixed income perspective, I think they number one, find diversity. Number two, find a pickup in spread. And number three, uncorrelated exposure versus public markets. I grew up in the public fixed income markets, for example, and 10 years ago moved into private credit for many of those reasons, because I think you can really, as a seasoned and experienced private credit origination firm where we focus and grow up, that we can then share with investors, I think, all of those benefits and add that value just as we try to do on the origination side of our business. It creates a holistic approach, which I think is quite attractive.
Yeah, if you look at the core returns and compare it to the BSL market or the broadly syndicated loan market and look at the S&P B index, for instance, and then you compare that to private debt, the core middle market risk return, the risk return is actually better in the core middle market. I think that's attractive for investors.
Absolutely. Thank you, Dan. Thank you, John. We're going to need to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and being a part of Global Investment Institute's Fixed Income and Alternative Credit Investment Forum.
Thanks very much.